Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know first $20 billion US bailout for Argentina bypasses Congress, igniting a political war over its impact on American farmers and hedge funds. So we'll discuss why this controversial move tests a new doctrine of foreign aid and what it means for the IMF's authority and global commodity markets. Second, China's record 888 million Golden Week trips mask a deflationary boom as brutal price wars reveal a hyper-competitive, low-profit economy. In this episode, we'll break down this deflationary boom and what it signals for global brands and Beijing's potential shift toward direct stimulus. Third, Trump weaponizes the government shutdown, freezing over $28 billion in funds to create localized recessions and challenge the municipal bond market. We'll examine how this targeted funding freeze creates a new political risk for the municipal bond market and threatens America's green energy race with China. The United States just fired a $20 billion financial cannon at South America, and the shockwaves are hitting Washington. The Treasury Department has confirmed it is buying Argentine pesos as part of a massive rescue plan to halt a severe currency crisis. Now, get this. The Treasury is able to do this by using a powerful but little-known tool called the Exchange Stabilization Fund, or ESF. This is a multi-billion-dollar fund that the Treasury Secretary can use with the President's approval for exactly this kind of emergency. The crucial part is that it doesn't require a vote from Congress, allowing the administration to act incredibly fast. It's a significant departure from the usual slower approach of working through institutions like the International Monetary Fund. The target is to prop up the embattled government of President Javier Milei, a leader known for his Make Argentina Great Again agenda. This is an enormous gamble on a nation that has defaulted on its debt 3 times since 2001. Here's where it gets interesting. This high-risk environment has attracted a very specific type of investor. For months, hedge funds have been placing huge bets on Argentina, a strategy known as the Argentina trade. They're betting that Milei's radical reforms will succeed and deliver massive returns. The US intervention, in effect, provides a safety net for these high-stakes gambles. Treasury Secretary Scott Bessent, the former currency trader who famously bet against the British pound, announced the US is prepared for whatever exceptional measures are warranted. He argues that the success of Argentina's reforms is of systemic importance, warning that American inaction could risk creating a failed state. This signals a potential shift in American foreign economic policy. The US is testing a new doctrine. Instead of relying on the IMF's slow, condition-heavy process, it's providing swift, direct support to a geopolitically friendly leader. While this was done successfully with a $20 billion loan to Mexico in 1994, it also creates what economists call moral hazard. The worry is that other countries might now pursue risky policies, expecting a similar direct bailout from a powerful ally, which would weaken the IMF's role as a global financial referee. But back in the US, the plan is exploding into a political war. Democratic Senator Elizabeth Warren immediately went on the attack, declaring, instead of using our dollars to buy Argentine pesos, Donald Trump should help Americans afford healthcare. And the criticism isn't just coming from the opposition. The intervention is also drawing fire from inside the president's own party. Republican Senator Chuck Grassley publicly questioned why the US would help bail out Argentina while it actively takes market share from American soybean producers, a core part of the administration's base. This creates a fascinating geo-economic paradox. China is the world's largest importer of soybeans, and its main suppliers are Brazil, the United States, and Argentina. By strengthening Argentina's economy, this bailout could boost its agricultural sector. So the US is shoring up a political ally, but in doing so, it could be helping that same ally sell more soybeans to China, directly hurting the American farmers who form a key part of the administration's political base. So, the US is backing President Milei's brutal austerity measures, sweeping cuts that have been welcomed by the IMF, but are fueling a deep recession and intense public backlash in Argentina. These painful cuts are, on paper, starting to work. For the first time in over a decade, Argentina recently reported a primary fiscal surplus. The $20 billion question is whether Milei can maintain this fiscal discipline and tame hyperinflation before his government collapses under the weight of public anger. The United States has now gone all in on one leader's radical free market experiment It is a $20 billion bet aimed at securing a strategic ally, but one that is simultaneously sparking a multi-front political battle right in its own backyard. Looking ahead, the key metrics to watch will be Argentina's monthly inflation reports and its fiscal balance figures. These are the signposts that will tell us if this massive bet is paying off. If Milei's plan succeeds, we could see the Argentine peso stabilize and its government bonds rally. If it fails, it could trigger another default and intensify the political fallout in Washington. For audiences in China, the focus should be on the global soybean market, as a boost to Argentina's exports could shift global trade flows and impact commodity prices. Speaking of massive economic bets and their complex outcomes, let's turn to China, where some staggering new numbers are telling a very different kind of story. China just saw a record-breaking 888 million trips during its Golden Week holiday, generating over 113 billion US dollars in revenue. But for business owners on the ground, it was anything but golden. One hostel group founder bluntly called it Golden Week. This isn't just about one bad holiday. We're actually witnessing what economists are calling a deflationary consumer boom. You see, while more people are traveling, they are also trading down, choosing cheaper options and spending less overall. This behavior puts downward pressure on prices, squeezing business profits and challenging the idea that China's economy is bouncing back on strong consumer spending. Behind that headline number is a story of a brutal economy-wide price war. Average spending per tourist actually dropped around 3% from pre-pandemic levels. The competition was so insane that some hotel owners were forced to slash rates by a staggering 60% just to stay fully booked. In major cities like Shanghai and Chengdu, average bed prices at hostels plummeted by more than 20%. And this points to a deeper structural issue. For years, economists talked about malinvestment in China's industrial sector, building too many factories. Now we're seeing that same problem create massive overcapacity in the service sector. There are simply too many hotels, especially in second and third tier cities, all fighting for the same price-sensitive customers. It's a leading indicator of future financial risks, suggesting these structural imbalances are morphing, not healing. If that was just the appetizer, the main course is the sheer exhaustion felt by business owners. One restaurant owner saw his daily sales surge from 3,000 yuan to 10,000 yuan. The catch? The average customer spent just 30 yuan, about $4 US. He said his team broke revenue records, but was so exhausted that when he suggested celebrating, they just asked to sleep instead. Another business owner put it plainly, everyone's working harder, spending more, but the profit gap stays small. This phenomenon has a name that will be familiar to many of our listeners, involution or Nate Gen. It's a state of hyper-competition where everyone works harder and invests more, but because everyone is doing the same thing, no one actually gets ahead. Profit margins get thinner and thinner, trapping the economy in a low-confidence, low-profitability loop. This is the reality of what's being called hyper-competition in China. Travelers are deal hunting like never before, with flights sometimes cheaper than train tickets, and booking last minute to catch the biggest price drops. The official data shows a travel boom, but the story on the ground reveals growing deflationary pressure, where record activity doesn't mean record profits. This trend has significant implications for what comes next. First, the failure of an extended holiday to generate strong per capita spending puts pressure on Beijing to consider more direct demand-side stimulus like consumption vouchers or direct subsidies, a tool they have so far resisted. Second, this new frugal tourist mindset is likely to spill over into international travel. As Chinese tourists venture abroad, again, their habit of hunting for deals will impact the pricing power of global brands, from luxury retailers in the EU to airlines in the US. We were just talking about the pressure on Beijing to inject stimulus into its economy. Now, let's shift our focus back to Washington, where the government is doing the exact opposite, weaponizing the lack of funding. We're only cutting Democrat programs. That was the direct statement from US President Donald Trump as the government shutdown stretches into its 9th day. The new development is how openly this is being framed as a permanent carve-out of what the White House calls Democrat programs, with opponents promised, quote, a little taste of their own medicine. This entire strategy is testing the very limits of executive power. A 1974 law called the Empowerment Control Act was specifically designed to prevent the president from unilaterally withholding funds that Congress has already approved. The current shutdown as weapon approach is trying to exploit a grey area in that law, setting a new precedent for fiscal battles in Washington. And these are not just threats. the administration has already taken action following a playbook architected by Russell Vought of Project 2025. On the first day of the shutdown, about $18 billion in funding for New York City infrastructure projects was frozen. Then roughly $8 billion in climate-related funding for Democratic-leaning states was cancelled. 2 days later, another $2.1 billion for a Chicago transit project was put on hold. That's over $28 billion halted in just days. When you target specific cities like New York and Chicago, you risk triggering localized recessions. The situation presents a fascinating duality. National economic data, like GDP, might look stable, while on the other side, it exposes severe downturns in specific regions. For instance, we're seeing New York's GDP growth slowing to just 1.5%, while at the same time, a state less dependent on this funding, like Texas, is projected to grow at 3.5%. This creates a patchwork economy where it's incredibly difficult for the Federal Reserve to set a single national monetary policy. And that brings us to the municipal bond market. This decision brings both political wins for the administration and comes with inherent risks for how cities pay for things. When the federal government suddenly freezes funds, it introduces a new kind of political risk into the market where cities borrow money for subways and schools. If investors get nervous, they will demand higher interest rates on those bonds. For a city like Chicago, that could mean higher borrowing costs, which eventually leads to either higher taxes or cuts to other essential services for its residents. However, if you zoom out, you'll see another layer of strategy at play. The White House is reportedly considering cancelling an additional $12 billion earmarked for clean energy projects. This move directly threatens the momentum of the Inflation Reduction Act, or IRA, which was designed to turbocharge America's investment in green technology. The sudden cancellation of public funding acts as a major investment shock, creating massive uncertainty and risking America's leadership in the green tech race to competitors like China, which already controls over 80% of the global solar panel supply chain. This all stems from a stalemate in Congress. The gridlock is the trigger, but a new strategy has been made explicit, leveraging the shutdown as an unprecedented opportunity to slash agencies and projects. This creates what economists call a fiscal policy uncertainty premium. Essentially, when private companies see that long-term government funding can be cancelled on a political whim, they get nervous. To compensate for that new risk, they will demand higher returns or simply won't invest at all, hurting the US economy's ability to attract long-term capital. So, to gauge the economic fallout, you'll want to monitor the credit spreads on municipal bonds for cities like New York and Chicago. If they widen, borrowing is getting more expensive. Also, keep an eye on city-level employment data to see if those localized recessions are taking hold. Finally, watch for announcements from clean energy and infrastructure companies about delaying capital spending. These will be the early warning signs of lasting economic damage.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.